Welcome back to another episode of Investing Explained. Here's today's question. What we're taught about the stock market is that it generally always go up, which is not surprising given that over the last 55 years, world GDP growth has been positive 51 of those years. So if we think that the stock market will go up, say, 10% annually, just like it has done from 1900 to 2000, why not, say, double or triple that return with a leveraged ETF? Unfortunately, that is not how leveraged ETFs work. They are not set up for long-term investors, but short-term investors. So if you want to speculate in what the S&P 500 does the next day, a leveraged ETF can be a very effective way if you're right. But there are several problems with this approach. First of all, you shouldn't really speculate at any time. And what the market does short-term is highly unpredictable. And another thing is that just as you gain more if the stock market is moving in your favor, it also punishes you really hard if it goes against you. Also consider that leveraged ETFs are very expensive, often around 1% in expense ratio, which comes right out of your pocket as an investor. And one of the reasons it's expensive is that it uses a combination of swaps and derivatives to get that leveraged exposure, which is just very expensive to acquire. I would highly discourage you to use leverage whenever you invest in ETFs. And if you are, which I again do not suggest that you do, a better approach is to buy a traditional ETF and buy it on margin, meaning that you borrow against the value of the ETF. They can in theory work short to medium basis. But over years, as a long position, it's not sustainable when the market tanks. And you will get called on, meaning that you'll be forced to sell your position at just the wrong time, unless you can back up your position with cash, which it defeats the entire purpose of using leverage in the first place. That being said, as much as we can come up with exceptions to using leveraged position as hedging and short-term bets, I really think it's the wrong question to ask. And again, I would really, for the fourth or fifth time, discourage any of our listeners to go that route. You need to know exactly what you're doing. And even if you do, the emotional biases with using leverage in stock investing will exponentially make it more difficult to manage your portfolio.
So here's what I'll tell you. Sometimes you have great ideas and sometimes you just want to kind of lever up on those ideas in order to maximize returns. And that's perfectly fine and perfectly acceptable. I do it. I would tell you the better vehicle for doing that is not a levered ETF though. So what you can do, and the best way that I found to kind of leverage a position and not have so much administrative friction eating away at your capital, which is how I view a levered ETF. I look at leaps, I look at options, long-term options like 2-year options in order to put on those positions because I don't feel like I get so much administrative friction. And let me define that for you. So when you do a levered ETF, Stig mentioned the fee, but the other part of that really chews away at your capital is volatility. So if you put on let's just say you buy an S&P 500 levered ETF, it's a 3X or a 2X ETF. When let's just say there's a lot of volatility in the S&P 500, even though there hasn't been that much volatility to date, but let's just say that position has volatility to it. What happens is as the managers of that ETF are rebalancing that position, that volatility really chews away at its ability to go 2x to the underlying security. So let's just say that the S&P 500 went up 10%, but there was a ton of chop in it going up 10%, meaning a lot of volatility going up 10%. Let's just say you're in a 2x S&P 500 ETF. I would highly doubt you're going to see that thing at 20% if it went through a lot of volatility to get up, if the underlying took a lot of volatility to get up to 10%. So the futures and all the things that they're doing in order to manage that levered position takes a lot of frictional cost, and that is reflected in the fact that it doesn't actually get to 20%. It might get to 18%, and you're paying for that. So what I would suggest, if you really, really want to lever a position, which Stig and I really don't recommend for people to do, but I know people are going to do it anyway. So this is how I would tell you is probably a better way to go about it is through an option. Just go out, buy an option, and I would suggest a long-term option. In fact, I would tell you, and I would highly suggest that you go read Joel Greenblatt's book, and the name of the book is You Can Be a Stock Market Genius. And Joel Greenblatt is a highly, highly accomplished investor for people that are not familiar with him. I would say his net worth is hundreds of millions of dollars, probably close to $1 billion. And he is brilliant, absolutely brilliant. I forget what his returns were with his Gotham fund that he ran for more than a decade, but I know that they were in excess of 20%. I actually want to say they were around 30%. They were extremely high. But anyway, in this book, he talks about his opinions on options, and particularly chapter 6 in the book is where I would focus. And what he talks about, and I remember some rules very clearly from this book. Rule 1 for Joel was don't mess with anything other than a call option. And I have kept this rule for myself for years. If I'm going to do an option, I pretty much only do call options. And he talks about the reasons why in the book. The other thing that he talks about in the book is your position size for your total portfolio. So let's say you have $1,000 in your portfolio. Your option should not be more than your entire options that you own should not be more than 15% of that entire portfolio. So if you have $1,000, you shouldn't have more than $150 invested in call options, leaps, which are the 2-year long-term options. So that would be my recommendation if you're interested in getting your hands into something that gives you a levered position so that you can put a little bit of capital forward and have a huge, massive return. But you got to realize that anytime you're dealing with options, that if whatever you put at the money, if it closes out below that, you're going to lose everything. I think the way that you manage that risk is you take smaller position sizes with the call options than you would with the levered ETF. And let me close by saying you probably shouldn't be doing any of this stuff because they most often are the result of being impatient opposed to having a super, really, really high probability idea.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.